All right, let's dive right in. Today, we're pulling back the curtain on a financial market that's so enormous, it's quietly working behind the scenes affecting pretty much everything, from your international travel plans to the global economy. It's a market that literally never sleeps, and in this explainer, we're going to break down exactly how it works.
So just how big are we talking? Look at this number. Almost $7 trillion. Now let that sink in. That isn't the total value of the market. That's how much money is traded in a single day. It completely dwarfs all the world's stock markets put together. It is, without a doubt, the largest and most liquid financial market on the planet.
So what is this beast? It's the Forex market, which is short for foreign exchange, or FX. At its heart, it's just the place where one country's currency is traded for another. But here's the kicker. There's no central building, no trading floor like the New York Stock Exchange. It's a massive, interconnected electronic network that runs 24 hours a day, 5 days a week, basically following the sun from Tokyo to London to New York.
Okay, so like with anything new, you've got to learn the lingo first, right? To really get what's going on, you have to speak the language. So let's build up our vocabulary with the absolute basics of how trading here works.
First thing to get your head around, you never just trade one currency by itself. It's always done in pairs, like the euro versus the US dollar, or EUR/USD. The first one, the base, is the one you're actually focused on buying or selling. The second one, the quote, is what you're using to do it. So if you buy the EUR/USD pair, you're literally buying euros by selling US dollars.
And when you look at a price, you're always going to see two numbers. The bid price is what you get if you want to sell the pair. The ask price is what you have to pay to buy it. And that super tiny difference between those two prices, that's called the spread. And that spread is essentially the cost of making the trade. It's how the broker gets paid.
So how do we even talk about these tiny price changes? We use a unit called a pip. For most pairs, a pip is just a one-digit move in the fourth decimal place. It sounds ridiculously small, right? And it is. But as you're about to see when you start trading bigger amounts, these tiny little pips can suddenly become very, very significant.
In this market, you can make money whether the price is going up or down. If you think a currency pair is going to get more valuable, you go long, you buy it, with the plan to sell it later for a higher price. But what if you think the price is going to tank? Well, you can go short. You sell the pair now, hoping to buy it back cheaper later. That ability to profit from falling prices is a really key feature.
So you don't just trade, 7 euros. Trades are made in standardized amounts called lots. A standard lot is a whopping 100,000 units of whatever the base currency is. But to make it accessible to more people, brokers also offer smaller mini lots and even smaller micro lots. This lets people get involved without needing a massive amount of starting capital.
And this table is where it all clicks into place. It shows you what those tiny pips are actually worth. If you're trading a big standard lot, a single pip move is worth about $10. If you're trading a mini lot, it's worth $1. And for a micro lot, just 10 cents. You can see right away how the size of your trade directly magnifies the impact of every little price tip.
All right, let's move on, because now we're going to talk about the single most powerful and honestly the most dangerous concept for any new trader. I'm talking about leverage.
So what on earth is leverage? Put simply, it's like getting a loan from your broker. It gives you the power to control a huge position in the market using only a small amount of your own money. It's usually shown as a ratio, something like 100 to 1. That means for every $1 of your own money, you get to control $100 in the market.
Let's make this real. Imagine you deposit $1,000. With 100 to 1 leverage, you can now control a $100,000 position, which, you'll remember, is a standard lot. Sounds incredible, doesn't it? A tiny price move in your favor could lead to massive profits compared to what you put in. But, and this is the huge but, it is a double-edged sword. It amplifies your losses just as powerfully.
And, well, this is the part we have to be really honest about. This number? This is the reality check. According to the stats that many brokers are required to publish, this is the percentage of everyday retail traders who end up losing their money. This isn't to scare you away. It's to make one thing crystal clear. The risk is immense, and leverage makes it possible to lose money very, very quickly.
And here's something you really need to understand. Your broker, they're not taking the risk. You are. If a trade goes badly against you and the money in your account drops to a critical level, their system will automatically shut down all your trades. It's called a stop-out. It protects them from losing money, but it locks in your loss, often wiping out your account.
Okay, shifting gears a little bit, let's zoom out and look at the bigger picture of this global market. Who's actually trading, and when is all the action happening?
So who's actually in this giant sandbox? Well, you've got the big dogs, the massive commercial banks. Then there's central banks who are in it to manage their country's currency. You've got huge corporations trying to protect themselves from currency swings and giant hedge funds making big bets. And then there are the retail traders. That's individuals like you and me getting access through a broker.
You see, the market never really sleeps. It's like a baton being passed around the world. It starts with the Asian session, then hands off to the London session, which is the biggest, and then over to New York. The most important time for a lot of traders is when the London and New York sessions overlap. That's when the market is usually the busiest and most volatile. So we've covered the what, the who, and the when. Now for the how. Let's get down to the nuts and bolts. How do you actually get a trade on and manage it?
Well, you don't have to be glued to your screen to enter a trade at the perfect moment. You can set up pending orders. Think of a limit order as setting a trap. You tell your broker, I want to buy, but only if the price drops to this level. A stop order, on the other hand, is like jumping on a moving train. You say, if the price breaks above this level, get me in, because I think it's going to keep going.
Okay, if you take away only 2 tools from this whole thing, make it these 2. A stop loss is your safety net. It's an order you place that says, if this trade goes against me and I lose this much money, get me out automatically. A take profit is the happy version. It automatically closes your trade when it hits your profit target, so you lock in your winnings before the market can take them back.
We've gone through a lot of the technical stuff, but this final section, this is the most important message in this entire explainer. Seriously.
It's this simple mantra right here. Knowledge first, capital later. This should be tattooed on the brain of anyone even thinking about trading. Before you ever risk a single dollar of your hard-earned money, your #1 priority has to be education. It has to be understanding the risks and practicing until you're blue in the face. So let's just boil this all down, shall we? 1, the Forex market is absolutely massive and complex. 2, leverage is an incredibly powerful tool that will amplify your wins and your losses. 3, the harsh reality is that most retail traders lose money. And 4, because of all that, education and risk management are not just suggestions, they are absolutely critical to survival. And that's where I want to leave you. We've laid out the mechanics and the pretty stark realities. So I'll leave you with a question to really think about. Knowing everything we've just discussed, what is the very first, most practical step you should take to build a responsible learning plan, long before you even dream of trading with real money?